I'd like to welcome everybody to the second part of our webinar on extended care solutions. And just, to kind of recap everything, we know that this is a very chaotic time, both in general and in our industry. We know that clients right now are looking for not only emotional support, but they're looking for some rational solutions that will help them deal with the potential what ifs. And we know that one of the best ways that an advisor can play both offense and defense is to use linked benefit solutions as a way to help their clients feel comfortable that they have one of the challenges of their financial life covered. So last time we talked about a few things. We're going to spend just a couple minutes on recapping some of the landscape of the opportunity. And I think a couple of key points. Number one is that only 11% of adults over age 65 own some type of a long-term care insurance policy. But we know that at least 70% of the people over age 65 are going to require long-term care services at some point in their lives. And if you haven't been paying attention, we know that the cost of care is skyrocketing. Right now it's at about $176,000 a year for private nursing home costs. That would be in about 20 years. Right now I would expect that it's probably close to $100,000 a year for private care. So we know that clearly this is a big marketplace. Again, 70% of the people over age 65 are going to need some form of long-term care during their lives. And if you look at the typical LTC buyer, right now 92% of the purchasers are under age 65. They're not yet retired. They own life insurance, fairly conservative from an investment standpoint, and household income of $100,000 or more. So you can see that the marketplace is very attractive from a client standpoint. And the interesting part is a lot of the buyers have had experience with long-term care. And I think one of the key parts of this marketplace as well, keeping in mind that women live on average 5 years longer than men, they tend to be the caretakers, and they are more than twice as likely to be the surviving spouse, and they tend to be unpaid caregivers as well. So one of the things that you can focus on with your clients is that long-term care coverage not only helps to provide care for the person that needs the care, but it also helps protect the spouse's health and the family's finances. So one of the things that we wanted to talk about today, and we spent a little time the last time talking about extended care solutions, but we want to get a little bit more focused on product solutions. And we've got Rob Johnson on the line with us today. Rob is a regional vice president with Lincoln Financial. Lincoln has an outstanding product in the MoneyGuard series. DBS, as you may know, is one of the largest, if not the largest distributor of MoneyGuard in the country today. And I want to remind everybody that DBS has an immense amount of expertise in the extended care marketplace. We understand the products, we understand the solutions, and we understand the need, and we're able to help advisors craft customized solutions for their clients. So I'm going to take now and just turn it over to Rob, and we're going to let Rob go through a couple of case studies and talk about some of the ways that the Lincoln product can help with your client needs. So Rob, it's all yours.
Great. Appreciate the introduction, Scott. Yeah, a couple things. First of all, I appreciate everyone taking time out of their schedule to join us, to join Scott and I today. A little bit about Lincoln, a little bit about MoneyGuard, and then I'm going to focus more on some case studies so you can think about clients that this solution may work for them. So a little bit about Lincoln, obviously well-known name, 115 years in this space, A+ rated with AM Best and Moody's. I think that's as important as ever. AA- with S&P. And according to the most recent Fortune 500, we were number 23 in assets. In this hybrid LTC space, according to the last LIMRA fourth quarter report, Lincoln had a 55% market share for these hybrid LTC solutions. MoneyGuard specifically has been around for just over 31 years. In fact, last August we celebrated 31 years. And we're well on our way. We made a number of enhancements over this past year, especially since August, to enhance our product and make it easier for you to present to your client. And we've listened to the field and made a number of changes. First of all, I want to start here by saying when we talk about extended care or long-term care, it is more than nursing home. If you've had conversations with your clients, if you've recommended extended care or long-term care, more often than not, they're going to think of nursing home. As the largest distributor of these hybrid LTC solutions, last year only 11% of our claims went to paying for a nursing home. 37% went to home care. And this is the fastest growing segment. That assisted living residential care facility was 51% of the claims we paid out. So important when we're having these conversations that it is more than nursing home. Only about 10% of our benefits are paid out to a nursing home. So a couple things, not looking to make anyone the MoneyGuard expert today, but what separates us? A couple things. One, we're the only carrier in this space that from day one has no elimination period. That's right. 0-day elimination period for nursing home, assisted living, home care, adult daycare, day one benefits. We also offer streamlined underwriting, meaning that your client will not have an APS ordered for them and there will be no paramed exam. So we've tried to make it as easy as possible. They're going to have an application and we're going to have a phone interview and then we're going to make a decision. So it's not something you have to resell 4 to 6 weeks down the line and remind the clients what they purchased. The goal is to have it streamlined and have a decision typically within about 5 to 7 days once that phone call has been completed. So that's enough about MoneyGuard itself. Let's look at some case studies. Where does it fit for your clients? And it's not a one-size-fits-all. In fact, the solution has evolved over the years. For many of you that when you think of MoneyGuard, you might think of it as a single premium leverage play. It's evolved. And now certainly it was. You purchase a certain amount up front. You had 3 to 4 times the leverage for long-term care. When we look at this slide, you're going to see 3 piggy banks. And you might refer to it as, you've heard it called live, quit, or die. I like to look at it as leverage, legacy, and liquidity. That biggest piggy bank on the far left side, that's your LTC pool of money. Typically, it's going to give you 3 to 5 times the leverage day one with the option of putting an inflation rider on there so that piggy bank continues to grow. That middle piggy bank, that's the benefit if they don't need care. That's the legacy benefit. What's unique to Lincoln is that death benefit can never be less than what they paid in. So they know there is no use or lose it. They know they're going to get at least back what they put in terms of either a tax-free death benefit or an LTC benefit. Finally, that piggy bank on the far right, that's the return of premium options. We give clients the option of 2 different that they choose up front. One that says, if I ever change my mind, I could get back 70% of what I've paid in. The other offers a graded return of premium that after 10 years, they could get back 100% of the dollars they paid into the policy. You go again, leverage, legacy, liquidity. They know they're going to get something out without an elimination period, and if they never need the benefits, there's a death benefit of at least what they paid in, if not more. So let's look at a case study first. You're going to see a 60-year-old female, my friend Susan. We offer a couples discount. As long as you're married, you get the couples discount. The spouse does not have to apply. We're going to give Susan a couples discount because she is married. This first case study looks at her purchasing a $100,000 Lincoln MoneyGuard. Now, keep in mind, I know some of you might say, well, $100,000, I have clients that may not have $100,000. Our minimum premium for this policy is that buys a $50,000 death benefit. So as long as it buys a $50,000 death benefit, you can use Lincoln MoneyGuard. So for Susan, she puts in $100,000. She has $472,000 for long-term care. If she passes away without ever using one penny of LTC benefits, there's a death benefit paid to her named beneficiaries of $170,700. If she changes her mind, this is that ROP option. She elected the 70% return of premium because that gave her the biggest LTC bucket. If she ever changes her mind, she gets back $70,000. Keep in mind that of the 31 years that Lincoln's been offering LTC solutions, only about 1.5% of people have ever utilized that surrender feature of the policy, and most of those happen during the first year. So not everyone wants to do a $100,000 single premium. We offer options to go anywhere between 1 and 10 years if you're 60 and older. Now, if you're 59 and younger, you can actually do a payment option that goes to age 70. So a 50-year-old could do a 20 pay. We're going to look at a couple of case studies. But for Susan, saying she wants to still use that total premium of $100,000, but would prefer to spread it out. She could elect to have a $10,000 annual premium for 10 years. She still gets over 3.5 times the leverage. She gets $361,000 available for long-term care. Death benefit, $130,000, and again, that's 70% return of premium. So whenever she surrenders it, if she surrendered in year 2 and paid in $20,000, she'd get back $14,000. If she were to surrender it after the 10 years, she would get back $70,000. So no matter when she surrenders it, she gets back 70% of what she paid in. So she could go with either of these two options. Certainly there's more leverage if she pays more of it up front. Now this was Susan. She was a 60-year-old. Let's look at a second case study. Now this couple, we have Victor and Gail. They're both 50. Our average client for MoneyGuard is right in that 55 to 65 range. We're going to look at Victor and Gail first. They got the couple's discount because they're married. They had postponed long-term care funding because of their children's 529 plans. A lot of you out there know about that struggle to pay off the house, fund the kids' college, while still wanting to plan for long-term care. So they each purchased a 15-pay policy with the goal of mine of being done paying on this policy by the time they retired. So they each purchased that 15-pay policy with about, if we look at the next slide there, you're going to see the pool of money that they each have here for them. So they each paid $9,282. Well, let's look at Victor. So he pays $9,282 for 15 years. By the time he's age 84, which is right about the time we see people turn on benefits, he's got over $1.2 million of tax-free LTC benefits. If he passes away, again, the legacy death benefit of about $156, and then that ROP using the 70% option of $97,000 if he were to change his mind. But again, paying $92.82, that premium's guaranteed for those 15 years. We can never come back and change that. We know he is guaranteed to have $1.2 million at age 84. Let's look at the next option, or plan design there. For Gail, she pays a little bit more. Claims for women typically last longer. About 70% of our claims are paid to women. Her premium is $11,133 each year for 15 years, but she's also got that $1.2 million. So between the couple, they have almost $2.5 million of LTC benefits. She has $155,000 for a death benefit. And again, her ROP, because her premium was a little bit higher, was 70% of what she had paid in, so a ROP of $116,000. Now we know there are those individuals that are a little bit younger, and would prefer to stretch out the premiums even longer than 10 or 15 years. We have a third and final case study. We're going to look at this one here. Ryan, he's 40. Now you might think 40, well, that seems fairly young. In fact, what we're seeing, we've just expanded our issue ages. So we now go from 30 to 80 years old. We used to go from 40, but we kept getting more and more feedback that advisors had clients that were affluent clients that wanted to put an LTC plan in place, but were in their late 30s or early 40s. So for Ryan, we've selected a 25-pay strategy. So for the next 25 years, he's going to pay $400 a month. That's well within his budget. That premium's never going to change for him. What does that get him? When we look at paying $400 a month for the next 25 years, he's done by the time he retires. By the time he needs long-term care, if we look at the next slide there, Ryan will have $2.1 million of tax-free LTC benefits by the time he's 84. So he paid $400 a month. That premium was guaranteed. Worst case scenario, if he never needs long-term care, the death benefit's $78,624, and again that ROP of $84,000. Again, this is just an example for a 40-year-old wanting to lock something in that's affordable to him while still providing over $2 million of tax-free LTC benefits. Now, if we look at the next slide, Lincoln MoneyGuard, and we've looked at three different scenarios here. We looked at that 60-year-old, we looked at that 50-year-old, we looked at the 40-year-old. So there are a number of different ways to fund this. You can fund it over a single premium over 10 years or to age 70, or you could use a 1035 exchange to fund this policy, or even do a combination of those. But we're going to look at who are those clients. When we look at our client base, one is that highly compensated individual. Their concern is that I want to have a plan in place for my future. Why? Because more leverage when they're young and healthy. We've seen it on that example for Ryan. He had $2.1 million. There's that sandwich generation, which we talked about really for that 50-year-old, knowing that, hey, we're still trying to pay children's tuitions, helping maybe with parents' expenses, especially if they're getting closer to 60. They're right in that gap there. But they want to have an LT strategy in place while they're still healthy, still fits within their budget. Thinking about that next individual, those clients that are nearing retirement, and that's when we think about those 60 to 65-year-olds that may have the flexibility to do a shorter pay, but would like to have something that maybe goes over the next 5 years or to age 67 or over the next 10 years. They're maxing out their retirement contributions at that time. They want some flexibility with funding. That's what MoneyGuard offers them, that combination of maybe a lump sum or an ongoing payment or using cash value from a life policy. So these are just three individuals when we talk about them. And then retirees with heavy tax qualified benefits. They want to protect their retirement savings. Why? Because they want to spread out their tax liability. Again, that flexibility to spread it out over 5 or 10 years because they're maxing out their retirement. They want to do something with that. That's a perfect candidate for Lincoln MoneyGuard. If we look at the next slide here, last three here. Executive top earners. You can all think about those executives, those clients you work with. Taxes are a big deal to them, so that thought of having either a tax-free LTC benefit or a tax-free death benefit, that's attractive to them. If we look at the next prospective client is those single females. Those single females who may not have a loved one that lives close to them, but they've been that caregiver. Scott spoke to it earlier. We know that women are the primary caregivers out there, so they know the physical and emotional toll being a caregiver can take. So they want to have a plan in place for themselves. And those clients in or near retirement. So those individuals that are 60 to 75, they could do that anywhere between a single pay and a 10 pay, or those high net worth clients. As a whole, Lincoln MoneyGuard, when we've continued to evolve the product, we wanted to have a solution that was easy for you to understand and explain to your clients, where the underwriting was easy, that provided maximum amount of LTC leverage with an inflation rider, so that LTC benefit continued to grow as they got older. And finally, having an LTC solution at the end that didn't require a deductible. I think that's huge when we think about LTC solutions out there. most having a 90-day elimination period. If you can offer something that when they need it, those benefits are available day one, that's an important thing. Last thing, I'm going to just turn it over to Scott, but I appreciate your time today. We're thankful for a partner like DBS who knows the extended care solutions out there in the market and really is a leader in this space. We're thankful to have partners like them.
All right. Thanks, Rob. I appreciate the great insight from a product and solution standpoint. And I think it's important to remind everybody of a couple things. Number one is this is really a broad-based marketplace. And I think one of the important things to remember from earlier is that 70% of people over age 65 are going to have a care event at some point. And as an advisor, I think it's critical that you're helping clients plan for that need. It's generally not an if something happens need, it's a when something happens, here's how we're going to solve the challenge. And as an advisor, I think you got a couple of options. Number one is you can plan from an asset standpoint which buckets you're going to remove those assets from in order to pay for those long-term care expenses. But the better solution is likely going to be having a defensive strategy, and maybe you redeploy some of the client's assets today for a solution that takes that risk away from both you and your client. And I think you saw that in some of the case studies that Rob talked about. It's a great opportunity to add some value to your clients, especially in today's world. And I'll leave you with the recommendation that as you talk to your clients, ask them what they've done to plan for long-term care expenses. And likely you're not going to get a lot of head nods that they've done things in the past. So it's a great opportunity for you as an advisor to help them plan for a likelihood. And the second thing then is call DBS. Call your case design analyst. They are spectacular resources. They've got the expertise. They can help you define the right solution for your client. We've got all kinds of carriers and all kinds of products available that will provide the right solution for your client. So again, thank you for taking some of your time with us today. We hope this has been valuable, and we look forward to talking in the future. Thanks.